When you've spent as many decades in the markets as I have, you learn that the most expensive mistakes aren't the obvious failures there, the comfortable illusions. The illusion that yesterday's winners will keep winning tomorrow. The illusion that a giant cannot lose its balance. And Microsoft, a company I've admired for over 30 years, is becoming a perfect example of why even the strongest businesses can be dangerous investments at the wrong price. Let me take you back to the first time I met Bill Gates. It was 1991. Bill already had that rare look in his eyes, focus mixed with inevitability. As we walked around the lake at his home, he told me, "Warren, the future belongs to those who adapt faster than they're comfortable with." And for decades, Microsoft embodied that principle better than anyone. But here's the uncomfortable truth. Today, the speed of innovation no longer guarantees investor safety, and the bigger the company gets, the harder it becomes to outrun its own success. People look at Microsoft's dominance in cloud, AI, enterprise software, gaming, they see a fortress. But I've learned in my life that a fortress can become a prison if growth expectations turn into obligations. Investors today aren't buying Microsoft for what it is. They're paying for what they assume it must become. That's a dangerous place to be. Whenever a company becomes so universally loved that people stop questioning the price, that's when I start questioning everything. And the questions surrounding Microsoft are getting louder. How much future growth is already priced in? How much risk is being ignored? And how much optimism is being mistaken for inevitability? Because inevitability in markets is a myth, one that has bankrupted more confident investors than any recession ever could. Microsoft has entered a phase where the expectations are so inflated that even great performance might disappoint. And that, more than anything, is what makes me uneasy. Now let me tell you something most investors don't want to hear. Size itself becomes a liability. When a company grows so massive that every percentage point of revenue requires moving mountains, the very scale that once protected it begins to slow it down. I've watched this happen before: Coca-Cola in the late 90s, IBM in the early 2010s, and yes, even Berkshire in certain chapters of its life. The world changes faster than our assumptions about the world, and that gap between reality and expectation is where investors lose fortunes. Microsoft today sits right in that gap. Everyone assumes AI will carry it to unimaginable heights, that Azure will keep swallowing market share, that the company's momentum is automatic, but momentum is never automatic. I remember talking to Bill about this during one of our old bridge games. He told me, "Warren, the biggest risk for a dominant company is believing its dominance is a law of nature. And I see investors falling into that trap now, not Bill, not Satya, but the crowd. The crowd is convinced that Microsoft is the safest bet in tech. But safety doesn't come from popularity. Popularity comes from a lack of critical thinking. When Wall Street analysts all repeat the same narrative: AI expansion, cloud resilience, enterprise stickiness, they're not predicting the future. They're recycling each other's confidence. And recycled confidence is the thinnest foundation in the financial world. Another thing I've learned: anytime investors begin using phrases like can't fail, unstoppable, or perfect execution, it means they've stopped doing the math. And the math right now says something simple. Microsoft's valuation demands perfection for a decade straight. Not great performance, not beating expectations, but sustained, flawless dominance in a world that is anything but predictable. And if even one of those assumptions misses by an inch, the price you pay today becomes a problem tomorrow. So when I warn that buying Microsoft might be a mistake, I'm not questioning the company. I'm questioning the price investors believe they must pay for certainty. Because certainty, in my experience, is the most expensive product in the stock market. And here's where most people misunderstand my caution. I'm not talking about Microsoft's products, its leadership, or its innovation engine. I'm talking about investor psychology, the most powerful and most dangerous force in all of finance. When investors start treating a stock like a savings account, risk hides in plain sight. I've seen this cycle repeat for 70 years. A great company rises, Wall Street falls in love, expectations inflate, and suddenly the stock stops reflecting the business and starts reflecting emotion. That's where Microsoft resides today, in the emotional premium zone, where optimism prices in a future that hasn't happened yet. Whenever investors say, well, I don't care what it costs, I just want to own it, that's exactly when you should care more than ever. Because price is not just a number, it is a promise. And Microsoft's price today promises impossible consistency in an inconsistent world. I remember back in the dot-com boom, everyone said the same thing about Cisco, Intel, AOL, companies that felt untouchable. They had dominant positions, endless growth stories, brilliant leadership. Yet their valuations were built on dreams, not margins, not cash flows, not economic realities. People lost fortunes not because the companies disappeared, but because expectations were inflated beyond rationality. That's the danger with Microsoft right now. AI enthusiasm is driving people to believe that every tech company will double its value simply by mentioning the word model or training data. But here's the truth no one wants to confront. When every company is chasing the same technology, the competitive advantage shrinks faster than the spending grows. Microsoft is investing billions every quarter to stay ahead in AI, but the market is acting as if those investments guarantee returns. In my world, there are no guaranteed returns, only risks that hide in the places people feel too comfortable to look. And the greatest of those risks is assuming that a company with $1 trillion valuation can keep climbing at the same rate forever. Economic gravity eventually arrives, even for giants. Especially for giants. Now let me take you deeper into the part investors always overlook, the hidden cost of greatness. When a company reaches Microsoft's scale, every strategic decision becomes a high-stakes wager. Innovation stops being optional and becomes a mandatory race for survival. But here's the irony: markets don't reward survival. They reward surprise. And when a company gets so large that surprising the market becomes mathematically difficult, investors start paying premium prices for outcomes that are no longer exceptional but merely expected. That alone should make you cautious. But there's more. Today, Microsoft is committing staggering amounts of capital into AI infrastructure, chips, data centers, energy, compute capacity on a scale the world hasn't seen before. People talk about AI as if it's a magical money printing machine, but they forget that the cost curve hasn't stabilized, the business models aren't proven, and margins are compressing in the very sectors investors believe will drive infinite upside. I've watched entire industries get crushed by the weight of their own enthusiasm. Railroads, airlines, telecom, every one of them looked like the future until the cost of maintaining dominance outgrew the profits. Microsoft now faces that same paradox. To stay ahead, they must spend aggressively. But the more they spend, the more Wall Street expects exponential growth. Expectations rise faster than revenues, and that widening gap is where investor pain forms long before it becomes obvious. And let me tell you something from experience. Anytime a company relies on flawless long-term execution to justify its valuation, the odds silently start shifting against the investor. Not because the company is weak, but because the world is unpredictable. One regulatory shock, one technological disruption, one geopolitical event, one competitor making an unexpected leap. It doesn't take a catastrophe to break a valuation built on perfection. It only takes reality happening at the wrong time. And AI is the least predictable frontier of all. The people buying Microsoft today at any price are not investing, they're forecasting. They are assuming not just strong performance, but a straight line trajectory into an AI dominated future where Microsoft remains the uncontested superpower. Yet history shows no company stays uncontested forever. IBM looked unbeatable. Nokia looked unbeatable. General Electric looked like the eternal king of American industry. Dominance feels permanent until the day it isn't. And if you've lived long enough in the markets, you realize that the biggest losses don't come from weak companies, they come from great companies bought at the wrong moment, under the wrong assumptions, at the wrong price. And if we're going to talk honestly, we need to confront the most uncomfortable truth in modern investing. The larger the narrative gets, the more invisible the risks become. Microsoft today isn't just a company, it's a belief system. Investors don't evaluate it, they worship it. They don't question the numbers. They assume the numbers will rise. They don't consider competition. They assume Microsoft will outspend, outmaneuver, and outlast. But beliefs aren't valuations, and confidence isn't cash flow. I've seen this pattern too many times in my life to ignore it. When a stock becomes a cultural symbol of safety, that's precisely when safety is gone. Think about it. Microsoft is now valued not for what it earns, but for what investors imagine AI might turn someday in a world that doesn't even exist yet. People are pricing in trillion-dollar futures before the business model is even proven. And that kind of optimism is exactly what makes me cautious. AI is devouring capital like nothing before it, billions spent on servers, power grids, cooling systems, workforce, supply chains, yet everyone behaves as if margins will magically expand. When costs rise faster than profits, that's not a growth story. That's a warning sign hiding under a tech buzzword. And every time I hear people say, "Don't worry, Microsoft will figure it out," I remember every era when the smartest people in the room made the worst assumptions. In 1999, Cisco could not fail. In 2006, housing could not fail. In 2019, WeWork could not fail. In 2021, crypto platforms could not fail. And yet, they did not because they were foolish, but because investors stopped asking questions at the very moment they needed to ask the most. That is exactly what is happening with Microsoft right now. Investors are treating AI like a destiny, not a technology. They're treating the cloud like a monopoly, ignoring how quickly margins are compressing across the industry. They're treating Azure as if competition from Amazon, Google, Oracle, Tencent, and every new sovereign cloud initiative doesn't exist. They're treating the Activision acquisition as if gaming is guaranteed growth despite cyclical demand, rising production costs, and constant regulatory threats. They're treating Microsoft Office as eternal, even though entire generations are shifting toward alternative ecosystems, automation tools, AI assistants that reduce the need for legacy software. And they're treating OpenAI as if partnership eliminates risk when in reality it increases dependency. When one company's future becomes intertwined with the unpredictable trajectory of an external partner, what you own is not a guarantee, it's a bet. And here's the most ironic part. The higher Microsoft climbs, the smaller the margin of safety becomes. That margin of safety, the difference between what you pay and what the business is worth, is the single most important concept in investing. And right now, that margin has been squeezed so thin it's practically invisible. As someone who has spent his life warning about valuation traps, I can tell you with absolute certainty, when even great companies start trading at prices that assume perfection, perfection becomes a risk, not an advantage. And the market has a long history of punishing investors who confuse strength with inevitability. Because inevitability doesn't exist. Not in technology, not in business, Not in life. So let me take you into the part of the story almost no investor is brave enough to analyze the systemic fragility that forms when a company becomes both indispensable and overvalued at the same time. Microsoft today is woven into the fabric of modern civilization. Governments run on its servers. Fortune 500 companies depend on its software. Global communication flows through Teams. Azure powers countless digital infrastructures, but the market is treating that dependence as if it reduces risk. In reality, it creates a different kind of risk, one that investors rarely consider: concentration. When everyone holds the same belief, buys the same stock, trusts the same narrative, and expects the same outcome, the entire system becomes synchronized toward a single point of failure. If Microsoft ever stumbles, not collapses, not fails, just stumbles, the shockwave would be amplified by the sheer number of investors leveraged to its success. And that amplification is where real danger lives. I watched this happen with IBM in the 1980s. It was the backbone of global computing. Governments depended on it. Corporations depended on it. Investors treated it as untouchable. But dominance blinds you to the moment the world moves without you. Microsoft risks that now, not because it's weak, but because disruption never announces itself politely. It arrives quietly, through unexpected players, through shifts in user behavior, through technologies that seem trivial at first and unstoppable later. Investors assume Microsoft will win the AI race because it's big, but size doesn't grant immunity to paradigm shifts. In fact, size often slows response time. And AI is not a gradual evolution, it's an accelerating revolution with no stable edges. Costs are exploding. Hardware bottlenecks are tightening. Data requirements are compounding. Regulatory scrutiny is rising globally. Energy grids are straining. Competition is becoming more aggressive, not less. Yet investors behave as if Microsoft is shielded from all external pressure by sheer reputation. That is not analysis, that is complacency disguised as confidence. And complacency is the deadliest force in investing. People look at Microsoft's cash flow and declare it a fortress. But a fortress can become a burden when expectations turn into obligations. Wall Street now expects Microsoft to dominate every frontier it touches: cloud, AI infrastructure, enterprise software, cybersecurity, gaming, hardware, developer tools, consumer ecosystems. No company in history has ever maintained flawless leadership across so many fronts indefinitely. It's not realistic, and the market's pricing doesn't reflect reality, it reflects fantasy. Expectations are now rising faster than execution can possibly keep up with. And when expectations rise faster than results, disappointment becomes inevitable. I've seen this movie too many times to pretend otherwise. Investors forget that every giant eventually hits the point where growth becomes constrained not by capability but by scale. $1 trillion company doesn't double the way a small company does. The world simply isn't large enough to support infinite expansion. But right now, the market has convinced itself that Microsoft must expand indefinitely, must grow earnings flawlessly, must capitalize on every technological wave, must avoid every misstep, must outperform every competitor. When you buy at today's valuations, you're not buying Microsoft, you're buying a fantasy version of it, a version that has no right to fail. And in my life, every investment that has no right to fail eventually teaches investors a painful lesson about what reality actually looks like, and now we need to talk about something even more critical: the illusion of infinite adoption, a trap that has seduced investors for over a century. People assume that because Microsoft's products are everywhere today, they will be everywhere tomorrow. But ubiquity is not permanence. It's a snapshot of the present moment, not a guarantee of the future. Every dominant technology in history looked irreplaceable until the next paradigm erased its foundation. The typewriter, the telegram, the mainframe, the DVD, BlackBerry, MySpace products woven into daily life, institutions too embedded to fail. Until they did. Microsoft understands this better than anyone. That's why they invest so aggressively. But investors don't factor in the cost of maintaining universality. The world is shifting toward AI-native tools, lightweight distributed systems, sovereign tech ecosystems, decentralized compute, and new productivity workflows that threaten the very assumption that Microsoft's traditional business model will remain the spine of the digital world. The market ignores this risk. It assumes Office will remain unchallenged, even as young workers pivot toward automation platforms that minimize manual software interaction. It assumes Windows remains central despite shrinking PC replacement cycles. It assumes Azure will win the cloud war while margins compress and competitors subsidize growth at unsustainable levels. And perhaps most dangerously, it assumes Microsoft's AI strategy will generate profit at a scale and speed never before achieved. But technology revolutions rarely reward incumbents with straight-line dominance. They rewarded adaptability, speed, experimentation, and willingness to cannibalize your own golden geese traits large companies struggle to sustain. When I talk to younger analysts today, they speak of Microsoft as if the company has discovered a cheat code for infinite compounding. They show me projections stretching 10, 15, 20 years into the future, all with smooth, upward sloping curves. But projections are fairy tales written with spreadsheets, and the market's greatest losses came from believing in fairy tales that sounded intelligent. In the 1960s, Nifty 50 analysts told the world certain companies were so superior that price didn't matter. They said growth was inevitable. They said dominance guaranteed returns. And investors bought those narratives until the market shattered them. Microsoft is not the Nifty 50, but the psychology surrounding it has the same shape, a belief that no price is too high, no risk is too real, no competition is too meaningful. That is where danger silently accumulates. Because when a stock becomes insulated from skepticism, it becomes vulnerable to reality. And reality does not care about investor enthusiasm. AI could face regulatory crackdowns, supply chain limits, ethical restrictions, taxation changes, energy crises. Cloud platforms could face pricing pressures, enterprise budgets could decelerate, a single strategic misstep delayed products. Overrated integrations, a misjudged acquisition could ripple through the entire valuation. And when a stock is priced for perfection, even mediocrity feels catastrophic. That's why I warn people. Microsoft's biggest risk isn't failure, it's expectation. Expectations so inflated that even great performance won't satisfy the market's appetite for miracles. And I've learned over the years that when Wall Street expects miracles, investors eventually learn the hard way that miracles are not part of the business model. And now we approach the part of the discussion that very few investors ever dare to confront, the compounding fragility of overconcentration, the moment when a company becomes so deeply embedded in the financial ecosystem that its stock ceases to behave like a business and begins to behave like a belief-powered asset. You can already see this happening with Microsoft pension funds lean on it. Index funds depend on it. Retail investors cling to it. Corporate retirement accounts are filled with it. Analysts tie their credibility to its success. Even global markets respond when Microsoft sneezes. And this kind of systemic entanglement creates a dangerous illusion that the stock cannot drop because too many people rely on it. But relying on something doesn't stabilize it, it destabilizes everything around it. When a single company, becomes the gravitational center of trillions of dollars in capital. Expectations inflate not linearly, but exponentially. Investors begin treating positive outcomes as guaranteed and negative outcomes as impossible. And that mindset is exactly what sets the stage for brutal corrections. I saw the same psychology consume the markets in 1972, 1999, 2007 every time investors believed they had found a perfect stock. But perfection is the most expensive illusion in the world. Consider the AI narrative that has completely overtaken Microsoft's valuation. Investors assume AI will revolutionize everything while ignoring the fact that revolutions are messy, unpredictable, and extremely costly. They assume Microsoft will maintain a technological lead, even though AI breakthroughs are happening globally, driven by open source communities, private research labs, and startups operating without bureaucratic friction. They assume Microsoft's partnership with OpenAI guarantees long-term strategic dominance. Even though history shows partnerships rarely produce permanent moats, they produce dependencies. And dependencies are vulnerabilities waiting to be exploited. But the most underestimated risk is this: AI is not guaranteed to be profitable at scale. It consumes energy at levels bordering on unsustainable. It demands supply chains that are fragile and easily disrupted. It invites regulatory scrutiny from governments desperate to control the next digital arms race. It introduces ethical, legal, and geopolitical battles that are only beginning to emerge. And yet, investors treat AI as if it were a risk-free multiplier for Microsoft's future earnings. That disconnect between exuberance and economics is where fortunes quietly evaporate. And as Microsoft pours tens of billions into AI infrastructure, the market refuses to consider what happens if returns don't match the investment tempo. I've lived through dozens of tech waves, from semiconductors to the internet to mobile to cloud, and every wave created winners, but it also created graveyards of companies that overspent, overreached, or overestimated their inevitability. Microsoft is not immune to that pattern. No company is. And here's something investors almost never talk about: the risk of strategic overextension. When a company fights on too many fronts — cloud, AI, gaming, enterprise, hardware, cybersecurity, developer ecosystems — the complexity becomes unmanageable. Execution risk multiplies, culture strains, decision-making slows, innovation bottlenecks, and competition, especially in technology, isn't courteous. It accelerates when it senses weakness. People forget how quickly giants can lose ground. In just 5 years, a single shift in consumer behavior or enterprise strategy can undo a decade of dominance. And while Microsoft is chasing a dozen battles simultaneously, its competitors, leaner, more aggressive, less burdened by legacy, are attacking with focus and speed. Yet investors refuse to consider that Microsoft might face a period of stagnation, margin compression, or even strategic misfires. They believe the company will always adapt, always pivot, always outperform. But always is not an investment thesis, it's a delusion. And the market has rewarded that delusion by pushing Microsoft's valuation to heights that assume flawless global leadership in technologies that no one fully understands yet. That is why I warn so strongly: buying Microsoft today isn't betting on the company, it's betting on a future with no volatility, no surprises, no setbacks, no competition, no regulatory shocks, no macroeconomic shifts. It's betting on a fantasy world. And the problem with fantasy is that it never survives contact with reality. And now, as we reach the end of this warning, let me tell you the truth that has guided every major decision I've ever made: value is not determined by admiration, it is determined by discipline. And discipline is hardest to maintain when the entire world is applauding a company. That's the moment when judgment becomes clouded, when confidence substitutes for analysis, when investors forget that even the strongest businesses can become dangerous when their price disconnects from their economics. Microsoft is a remarkable enterprise. I've said that for decades. I admire its leaders, its culture, its strategic vision. But admiration is not a reason to buy a stock. The reason should always be the same. You believe the intrinsic value exceeds the price you're paying. And right now, that equation is inverted. Investors aren't buying Microsoft because it's undervalued, they're buying it because they fear missing out. They see AI headlines, explosive enthusiasm, trillion-dollar valuations, and they assume the story will continue in a straight line. But stories don't move straight. They dip, twist, fracture, reset, and companies, this large companies, under this much pressure to outperform expectations quarter after quarter, eventually face the weight of their own momentum. I've spent a lifetime studying market psychology, and I can tell you with absolute certainty, the moment a company becomes a symbol of guaranteed prosperity, the danger is already in the room. Because when faith replaces analysis, when narrative replaces numbers, when excitement replaces skepticism, the investor becomes vulnerable to the one force no one can escape: reality. Reality which doesn't reward hype, reality which doesn't care how beloved a stock is, reality which doesn't bow to valuation models built on hope. And the reality for Microsoft is simple. At today's prices, you are not buying predictable growth, you are buying perfection priced as destiny. And destiny is not a strategy. The world will change again. New competitors will emerge. Regulations will tighten. Technologies will shift in directions no analyst can forecast. And someday, maybe soon, maybe later, Microsoft will deliver a quarter that is merely good instead of miraculous. And when a stock priced for miracles delivers something human, investors will react not with patience, but with shock. That shock is where portfolios break. That shock is where wealth evaporates. That shock is what I am trying to warn you about. You don't avoid disaster by assuming greatness lasts forever. You avoid disaster by demanding a margin of safety even from the greatest companies on earth. And right now, Microsoft offers none. So when I say that buying Microsoft today might be a big mistake, I am not criticizing the company. I am reminding investors of a lesson written in every market cycle since the beginning of capitalism. A wonderful business bought at the wrong price becomes a terrible investment. And if you forget that, the market will remind you painfully, decisively, and always at the worst possible time. That's the truth, whether people want to hear it or not.